Hello, this is Larry Pond. I'm a CPA and certified financial planner. Today, we're going to talk about the American Rescue Plan and the tax provisions that are in there. This law was just signed by President Biden on March 11th, and there are some significant tax provisions there among the many aspects of this bill. So I'm Larry Pond. I've been working on taxes for the last 35 years, and I really enjoy talking about tax planning and tax preparation. So I hope you enjoyed this time. So today we're going to talk about these items here. So what we're going to cover today is the American Rescue Plan Act. So we're going to talk about the unemployment benefits, the recovery rebates, the child tax credit, the earned income tax credit, premium tax credit, student loans, and some business tax provisions. And then we'll talk about what to look for on your 2020 tax return: charitable donation deductions, teacher deductions, cryptocurrency enforcement, gig workers, home office deduction, retirement plan distributions, and how you can still lower your 2020 tax bill. So let's get started with unemployment benefits. Major last minute change brought on by this bill, something we, as tax professionals, we were not expecting. And also, we've completed a lot of tax returns already. And a lot of taxpayers have already filed their tax returns. So what the American Rescue Plan provides is that the first $10,200 of unemployment benefits are tax-free for 2020 for taxpayers making less than $150,000 per year. So if you're making less than $150,000 and you received unemployment benefits, the first $10,200 is now tax-free. So what do you do about the tax returns that are already filed? I already sent my tax return. What do I do? Well, the IRS gave us some recent guidance telling us, do not amend already filed tax returns. They're trying to figure out how to implement this law change. So they say, wait for guidance. So we'll see what the IRS is going to say. Are they going to automatically refund those affected tax returns, or are we going to have to look for them ourselves? And of course, our software will need to be updated to take this into account. Now, this provision has no phase out. So what that means is your income's over 150,000, boom, all the unemployment benefits are taxable. And the $150,000 limit applies to all tax returns. It doesn't matter if you're married, single, head of household, married filing cert, it's $150,000. Now, if you have two spouses filing jointly who receive unemployment, the $10,200 exclusion applies separately to each spouse. Now, unemployment benefits are reported on Form 1099-G that's issued by the Employment Development Department, the EDD. In California, it's called the EDD. Well, many taxpayers have received fraudulent unemployment benefits. What if you got a fraudulent 1099-G? What do? Don't ignore it. Don't leave it out of your tax return, because if you leave it off your tax return, you will get a notice from the IRS. It would be a CP 2000 notice from the IRS saying, hey, you got to pay tax on this amount. So the IRS says, report the correct amount on your tax return. So if, let's say you had a 1099-G that says you got $20,000 of unemployment. You never got it. You never applied. Happened to many people who weren't even working, who were retired. So report the 1099-G on your tax return as unemployment income, and then on the other income line, back it out. Put a negative number in there, put an explanation on your tax return saying this is a fraudulent 1099-G. Most importantly, contact the EDD to let them know you got this fraudulent 1099-G so they can open a fraud investigation to resolve this problem. Now, I got to remind you that unemployment benefits are taxable on your federal return, but not on your California return. And the maximum amount of withholding you could have gotten on this unemployment was 10%. So you got to watch out. And in many cases, many people wanted the entire benefit, so they didn't have any taxes withheld. So you got to watch out that many people are going to be owing this year due to unemployment benefits. Even with that $10,200 exclusion, I've seen people receive $30,000 to $50,000 of unemployment benefits. So it could be quite a bit. The American Rescue Plan also provides for extension of the Pandemic Unemployment Assistance, the PUA, until September 6th with a $300 per week boost. So a lot going on with unemployment benefits. The 2020 recovery rebate, the $1,400 recovery rebate. You might have gotten yours already. The IRS has been making direct deposits for people where they have their bank information and the checks are coming out. So they're coming out pretty quick. It's $1,400 per person for a married couple. That could be $2,800 and $1,400 for each dependent for 2021. That includes college students and qualifying relatives who are claimed as dependents. So this could mean a lot of money to you. Now the phase out is at $75,000 if you're single, and then completely phases out $80,000. So it's a pretty quick cliff. If you're married filing jointly, that's $150,000, and it phases out $160,000. Head of households $112,500, and you completely phase out $120,000. So the IRS is going to look at what tax returns they have on file. If you haven't filed your 2020 tax return, they're going to look at the 2019 numbers. And so if you have a higher income in 2020, which would eliminate you from getting this recovery rebate, but your 19 income would, then you might want to hold off on filing your 2020 tax return until you get the rebate. So now, however, if your 2020 income is lower than your 19 income, which would entitle you to this recovery rebate, file your 2020 tax return as soon as possible so you can get the money now. Now, what if you file it later and you're entitled to this rebate, but you didn't get it? You will reconcile it on your 2020 tax return next year in 2021 when you're filing this tax return. So what about those first two rounds of stimulus payments? You know, $1,200 for the first round, $1,100 per dependent for under age 17, and then the $600 the second round, which came in January. What if your income in 2020 is lower and that you qualify? So you can get those stimulus payments if you're eligible for more. And you report that on line 30 of your Form 1040, the recovery rebate credit. So take a look at the worksheet and the instructions on how to compute this, and you put that number down on line 30 of the 1040. You only do this if you're entitled to more than what you received in advance. So, for example, you had a child that was born in 2020. The IRS didn't know that. But if you got too much because your income is too high and you wouldn't be eligible or whatever reason, there's no obligation to pay it back. Now, on the IRS website, irs.gov, click on the link on Get My Payment. So irs.gov/coronavirus/get my payment to take a look at the status of your recovery rebate or to give the IRS information so you can get your checks. Significant changes to the child tax credit. Now it's fully refundable for 2021, and it treats 17-year-olds as qualifying children. Under the previous law, it was not refundable. What does refundable mean? It means that if the credit is higher than your tax liability, you will get a refund. If it's non-refundable, the credit only takes you down to zero. You're not going to get an extra check for it. So this is a significant change. It's a refundable credit. And also the limit was age 13. So previously, once your child's over age 13, there's no more child tax credit. Now it's up to age 17. It's $3,000 per child and $3,600 for children under 6. Now there's a phase out, $150,000 for married filing jointly, $112,500 for head of household, and $75,000 for singles and others. Now the IRS is being directed by Congress to estimate your child tax credit amount and pay in advance of the annual estimated amount. And this will start in July, running through December of 2021. So you will be getting checks or direct deposits for the child tax credit. The IRS has also been directed to set up an online portal to allow taxpayers to opt out of these advance payments. So if you don't want the advance payments, but you want to take it on your tax return, you can opt out. So I'm looking forward to this online portal. Also, you can provide information on this portal that might modify the amount. Maybe your income's higher now, so you won't be entitled to as much of the child tax credit. Because if you don't do that, the IRS sends you these credits, and let's say you weren't entitled because your income's too high, well, you got to pay it back. So this will be reconciled on the 2021 tax return, just like those recovery rebates. That's on your tax return. So for taxpayers whose modified adjusted gross income does not exceed 200% of the applicable income threshold, which is now $60,000 for married filing jointly, will have the increase for an in excess advance payment reduced by safe harbor amount of $2,000 per child. The earned income tax credit has been significantly expanded also under the American Rescue Plan. So the minimum age has now been decreased to age 19. There's an exception for students at age 24 and qualified former foster youth or homeless youth. That's age 18. The maximum age has now been eliminated. It was 65. If you're over 65, previously you were not entitled to the earned income tax credit. So the maximum age has been eliminated. The credits phase-out percentage is increased to 15.3%, and the phase-out amounts are increased. And the credits allow for certain separated spouses, and there's a threshold for disqualifying incomes and raised from $2,200 to $10,000. So taxpayers are allowed to use their 2019 income instead of their 2021 income in figuring the credit amount. So you will have a choice. So we take a look at your 19 return or whatever. So it's going to be important. So when you're doing a tax return, not just have last year's tax return, you also have to have the previous year's tax return also. The child and dependent care credit, daycare for your children or your dependents. Well, again, in 2021, it's now a refundable credit, and it's been expanded to 50% of eligible expenses. Of course, there's a limit based upon your income level, but $4,000 for a qualifying individual and up to $8,000 for 2 or more kids. So that's a nice increase over what it was previously. And the credit reduction will start at income levels over $125,000. And if households have incomes over $400,000, the credit's reduced below 20%. Also, if you have a dependent care plan at work, the exclusion has been increased to $10,500 for 2021. Previously, you were limited to $5,000. So up to $10,500. That might make sense than taking the credit. So we'll have to run the numbers to see which works out better. So stay tuned with your benefits package that you can actually put more into the dependent care plan. Premium tax credit. If you get your health insurance through the healthcare exchange in California, it's called Covered California, the premium tax credit being expanded for 2021 and 2022 by changing the applicable percentage amounts. So it eliminates the upper income limit for eligibility. And of course, you have to get the insurance from Covered California and go through the menu of choices there and the different tiers. So the premium tax credit has been increased for taxpayers receiving unemployment compensation in 2021 and taxpayers who receive too much in advance premium tax credits in 2020 will not have to repay the excess amount. So for example, you got a subsidy of $20,000 for your health insurance, but your income turned out to be too high. And previously, you would have to pay the entire $20,000 back. Well, under the American Rescue Plan, you don't have to pay back if you got too much. So that's something to definitely take a look at. Now, this is for 2020. So if you filed your tax return already, we'll have to see what we need to do to correct that. Also, there's a benefit for 6 months of free COBRA benefit. So there's 100% COBRA premium subsidy for certain employees who lost group health plan coverage due to an involuntary termination or reduction in hours. And that's from April 1st and ending on September 30th of 2021. The 6 months of free COBRA is not income. So it's excluded from income. You won't get this reported on your W-2. Work with your group health plan sponsor to take advantage of this benefit to see if you qualify. 6 months of COBRA. That's a pretty good deal. Student loans. So what's going on with student loans? In the American Rescue Plan, many citizens and Congress members were hoping for student loan forgiveness. That didn't happen. It wasn't part of the bill. However, what the bill did do was that any discharge of student loans from the next 5 years, from 2021 to 2025, will not be taxable. Normally, any forgiven student loans are taxable income. After you get your loan forgiven, you get a 1099 that you got to pay taxes on. Previously, this only applied to discharges in exchange for working in certain professions, such as a doctor in a public hospital in a rural area, or discharges on account of death or total disability of a student. So I had a client who was a dentist. She graduated from dental school with student loans. She had to work at an Indian tribe, and for a certain amount of time, her total debt was written off. That was a pretty good deal for her and not taxable. So there's a lot of those programs out there. It was very helpful in paying off medical student loans or even law school student loans. And the loans are expressly for post-secondary educational expenses if the loan was made, insured, or guaranteed by federal, state, or local government entity or an eligible institutional education. Private education loans qualify, and loan made by an educational institution qualifying as a 50% charity or a tax-exempt organization. Take a look at that. So here's some business tax provisions that are in the American Rescue Plan. The employee retention credit has been extended and expanded. It was going to expire on June 30th of 21. Now it goes to December 31st of 21. And it's a 70% credit up to $40,000 of qualified wages per employee through 2021. So that's a significant amount of money. Also, an expansion of employer credits for paid sick and family leave benefits. So it goes from March 31st. It's been extended to September 30th of 21. What also has been expanded is that the leave also covers time taken off for a COVID-19 vaccination. So you got to take time off of work to get vaccinated. That gets eligible for a tax credit for the employer. There's credits for providing subsidized COBRA benefits, up to 85% subsidy for COBRA premiums as an employer paying for your former employee's COBRA. And also there's the restaurant revitalization grants to cover restaurant business losses. That's $28.6 billion to be administered by the Small Business Administration. So take a look at the SBA website to see if your business will qualify and how to calculate it and what the eligible expenses are and how to get your share of that money. So let's talk about the 2020 tax returns that we're filing right now. First of all, let's talk about charitable donation deductions. Most taxpayers don't itemize. The standard deduction has been increased, $12,500 for single, $24,800 for married filing jointly, and $18,650 for head of household. So for 2020, if you're not itemizing, taking the standard deduction, you can deduct up to $300 for cash charitable contributions to charity. It could be any charity. It does not have to be a coronavirus related charity. $300. What's the amount for married filing jointly? $300. For 21, for this year, for married filing jointly, it's up to $600. And that's reported on line 10B of your form 1040. And this is for cash donations only. And you can pay it by cash, check, or credit card. It's not for property donations, not clothing, furniture, or non-cash items. And for 2020 and 2021, the limit on cash donation is 100% of adjusted gross income. And in 2022, it's going to go back to the 60% of adjusted gross income limit. So we can make some substantial charitable donations. Now, for our teachers, if you're an eligible educator, you can deduct up to $250 of unreimbursed educational expenses. It could be $500 for married filing jointly if both spouses are eligible educators. These are K-12, teacher, instructor, counselor, principal, or aide for at least 900 hours a school year. And the qualified expenses include professional development courses, books, supplies, computer equipment, etc. One expense I noticed was webcams, because I couldn't get a webcam because the vendor told me, yeah, they're all being bought by teachers. So that's part of the qualified expenses. What's new for this year? For expenses after March 12th of 2020 also includes um, personal protection equipment, PPE. That could be a hood, a mask, masks, gloves, gowns, or whatever, PPE, disinfectant, and other supplies used for the prevention of the spread of the coronavirus. So those are included expenses in there. Cryptocurrency enforcement. So on last year's tax return, there's a question about cryptocurrency, but it's buried like in the fourth page of the tax return. Well, guess what? It's on the front page of the tax return, right underneath your name and address. So how prominent can that be? It's right there on the first page of the tax return. So on the form, it says, at any time during 2020, did you receive, send, exchange, or otherwise acquire any financial interest in any virtual currency? Yes or no? So if you have, you make sure you answer that correctly, because if you did not answer correctly, and if you did have cryptocurrency and you didn't report it, you'll be subject to some severe penalties because you didn't say yes or no to that question. Nothing wrong with saying yes or no. Just make sure you answer it truthfully. In 2019, the IRS sent over 10,000 letters to taxpayers warning they may not be in compliance. Those letters came in three forms. The first letter from the IRS, one letter would have been, hey, we think you had some cryptocurrency. Take a look at that. Very soft letter. The second letter says, we know you have cryptocurrency and you may have a requirement to report that on your tax return. So take a look at your information. The third letter says, we know you had cryptocurrency and we know you have transactions that you did not include on your tax return. Please report it now. Otherwise, we'll figure it out for you. And you know how that's going to go. And so all the cryptocurrency transactions must be reported on Schedule D. Gig workers. There's a lot of gig workers out there. So you might get a Form 1099 NEC or Form 1099K reporting income from the gig work you're doing through one of these app-based gig companies. But don't forget to claim deductions. You got mileage, you got supplies. You're probably buying PPE, gloves, masks, water, disinfectant, wipes, all those kind of things. You paid all kinds of fees to the gig company. So make sure you report the year-end statement that shows all the fees they took out of your gross pay, because the 1099 will report the gross amount, not the net amount. Keep good records. And also, there's a new deduction called the qualified business income deduction that you would be eligible for. It's a 20% deduction on your net business income. It's a pretty good deal, right? So effectively, you're paying tax on 80% of your income, but you're not going to get that unless you fill out the form 8995A or 8995. Don't forget to do that. And also, you'll be paying your Social Security tax on Schedule SC, the self-employment tax. So make sure you're very careful if you're a gig worker to make sure you claim all the deductions you're entitled to. We get this question a lot. Home office deduction. We're working from home. Our office got shut down. I've got to work from home. Can I deduct anything? Well, short answer is, if you're an employee, the answer is no. Since the passage of the Tax Cut and Jobs Act, there's no more deduction for unreimbursed business expenses. Well, in California, it's still deductible on your California return, subject to 2.5% of your adjusted gross income. Well, how about asking for reimbursement by your employer? Then the question is, who owns the equipment? I bought a monitor. I bought a stand for a monitor. I bought a chair. I bought a desk or whatever, and I want to get reimbursed by my employer. Well, some companies, let's say they reimburse you, they'll send you an asset sticker to stick on the back of the monitor, chair, or whatever, because technically they paid for it. The company owns it. Some companies are giving an allowance to their employees, like $500 to go use to buy a monitor or whatever. that's taxable because that's not what's called an accountable plan. So if you get an allowance, it's going to be taxable. Now, if you're self-employed, the answer is yes, you can claim a home office deduction. Of course, you got to make sure you qualify for that. And that's all reported on Form 8829. You can either use actual expenses, which means a percentage of your property tax, mortgage, rent, insurance, repairs and maintenance, and those kind of costs, or the simplified method, which simply takes $5 a square foot. So whichever is easier for you. Last year, there are some changes to retirement plan distribution. This was brought in by the CARES Act. So we have what's called coronavirus-related distributions, CRD. Now, you have a CRD if you meet certain requirements. Were you infected by COVID-19? Was your spouse affected or infected? Or a household member? They don't have to be related to you. A member of your household was infected or affected. Your hours got cut due to the pandemic, or you got laid off, or your job offer was rescinded. If you're affected by it, you would qualify for the CRD. The limit's $100,000 for a retirement plan, no early distribution penalty if you're under age 59 and a half. And most importantly, you pay the taxes on this over 3 years. Now, there's no tax if you're able to pay it back within those 3 years. If you can pay it back within 3 years, there's no tax. This is reported on a new form 8915E. You can take a look at that, look at the instructions. This is for 2020 only. No discussion from Congress of extending this into 2021. Although in 2021, we have what's called disaster-related distributions if you qualify in a nationally presidentially declared disaster. Also for 2020, RMDs have been suspended. So if you normally would have a required minimum distribution, you didn't have to take it in 2020. And if you did take it in 2020, you had until August 31st to return the money back to your retirement plan, so it would not be taxable. Here's how you can still lower your 2020 tax bill. It's not too late. There are things you can do to reduce your 2020 tax bill. Number one, contribute to a traditional IRA. First, you got to see if you qualify. See if you meet the qualifications for that. It's $6,000 if you're under age 50 or $7,000 if over age 50. You got till April 15th of 2021 to fund a traditional IRA to be deducted on your 2020 tax return. Got to check if you qualify though. There's a lot of rules to look at there. If you're self-employed, contribute to a SEP IRA or a simple IRA or some other self-employed retirement plan. It's based on your self-employed income. Got to fund it by October 15th of 2021. So with the passage of the Secure Act that passed at the end of 2019, it's given us a lot more flexibility in choosing a retirement plan if you're self-employed. Contribute to an HSA if you have an HSA qualified health plan. You've got till April 15th to max out your HSA contribution. They're wonderful to take advantage of. You get a deduction for putting money into the HSA. And if you use the money for out-of-pocket medical expenses, it's completely tax-free. So it's a pretty good deal. How else can you lower your taxes or lower your tax bill? Well, let's avoid penalties. Save on penalties. So even if you file an extension, that's fine. The extension takes you to October 15th, but you still got to pay by April 15th of 21. So there's no extension to pay, just extension to file. Also, make sure you avoid underpayment penalties. That means paying enough tax during the year to avoid a penalty, because that's just the extra cost, right? So to do that, you pay the lesser of 100% or 100% of last year's tax liability or 90% of this year, whichever's less. So you can save some money that way. Here's a couple of links of some resources if you're interested in looking at it. The American Rescue Plan of 2021. It's only 242 pages. Here's the PDF to that. Also, Publication 17 from the IRS. It's 138 pages. Very comprehensive. Covers almost every line of the tax return. Not every line, because there's some specialty forms, but they'll make you make a reference to those forms. You can read the instructions. So there's some resources there. So I hope this was helpful. Thank you for your time, and I wish you the best financial health. Now, reach out to me if there's other topics you'd like to see covered. I love talking about tax and financial planner. It's something I really enjoy doing. And thank you for your time. And please stay healthy. Thank you very much. Bye-bye.